Welcome to Inside India. I'm Amitabh Singh, and these are your headlines at this hour. India's farmers are set to hold nationwide protests later today over the US-India trade agreement, which they say will be detrimental to the agricultural sector. We're watching Fractal Analytics' $300 million IPO fully subscribed on its final day of bidding. The company looking to become India's first listed pure-play AI company when it hits the markets on Monday. LG Electronics, India's quarterly net profit more than halves, as cooler weather also meant cooler demand. All right, let's get a sense from JP Yong whether the markets in Asia are hotter or cooler. JP, what's going on?
Well, how about lukewarm, Amitabh? And a bit split, actually, depending on which part of Asia you're looking at, because it is a basket of mixed fortunes when you look at how some of these major indices are trading in today's session. We'll get into how hot the Hang Seng is trading in just a little bit, but keep in mind the Taiwanese markets have already started their celebrations for the Lunar New Year holiday, and they will be offline for the rest of this week and most of next week as well. The South Korean Kospi, once again, impressing today, surging by about 2.5%. But the curious case of the Nikkei 225 is something we want to highlight, because today we did see them open above 58,000 or breaching 58,000 on the back of the Takaichi trade. But that reversed quite significantly over the last couple of hours. And if you can just pull up this particular chart to show people when it happened, you'll notice here that the Nikkei 225 saw its gains actually come down as soon somewhere around the time when the Japanese yen strengthened below 153 to the US dollar. Now, as we know, the strength of the Japanese yen happens usually is inversely correlated to how exporters in Japan trade. Usually when the yen strengthens, it does weigh on equity sentiment. It seems to have done that so far in today's session. But keep in mind, they're only trading about 0.1% lower than Tokyo benchmark. We take a look at some of these markets out in Hong Kong as I catch my breath and steady my cough there, and you'll notice that tech stocks are worth looking at. Tencent, JD.com, and Meituan, all three in the red, with reports from the South China Morning Post that they have been summoned by Chinese regulators because of irregularities with regard to the sale of train tickets leading up to the Lunar New Year holiday, where you see hundreds of millions of Chinese traveling during this particular festive period. Those irregularities have come under question by many consumers there, and there's weighed on stock sentiment there. Zhipu AI, though, trading 23% higher after they launched a new language model, actually a new AI model out there that's catching the attention of a lot of people in the markets. Stock surging by 23%, and of course we can't end without talking about China Vanke. There is a report in Octus right now that the Shenzhen government is preparing an $11 billion bailout package for the embattled property firm, and you can see their shares reacting positively, 5.7%. Whether or not the report does hold any water is something we'll have to verify, but it's enough to at least send a lot of these shareholders who are hungry for positive news on China Vanke, the property sector, soaring so far this Thursday morning. Amitosh?
All right. Thanks so much for that, JP. A lot to cover. The Indian markets, they come online in about 45 minutes. Gift Nifty futures are indicating a couple of different things, but mostly that it is going to be muted. Still flirting with 26,000. Remember, Nifty notched up a fourth straight session of gains, though the upside remained modest, while the Sensex ended slightly slower or lower. Still flirting with 26K, as I said, and rising only 18 points. Sensex slipped 40 points to 84,233. Now, Gift Nifty also indicated that there will be perhaps caution among some investors as they wait for more details around both the US-India deal and CPI inflation data that is expected today. A new series is expected today, and of course, a busy earnings day. Foreign investors were net buyers of Indian shares for the fourth consecutive session. Also, Indian government bonds are likely to give away some of their recent gains today, as in the early deals, that is tracking a rise in US Treasury yields. And we are also expecting that domestic inflation data, and that might be a major trigger. Farm unions and opposition parties in India, crucially, are gearing up for nationwide protests against the new India-US trade framework, warning that it could expose Indian agriculture to cheaper American imports and squeeze rural incomes. The Samyukt Kisan Morcha, a farmers' group, has called for protests today, saying the deal amounts to a complete surrender to US agribusiness and could hurt oilseed growers, apple farmers and other producers. The government insists key staples like rice, wheat, corn and dairy are protected, and says products like basmati rice Fruits, spices, tea and coffee will actually benefit from duty-free access to the US market. But farm leaders and the opposition, Congress party, say the pact lacks transparency and could turn India into a dumping ground for subsidized US farm goods. Here's what some of the protesting farm leaders had to say.
There are 800 million farmers in the country. Their crops will be destroyed and it will be taken over by corporations. Already, our farms produce, be it palm oil or coconuts. We don't get enough compensation. And if this deal gets implemented, then we, the country's farmers, who are already not gaining profits, our markets will be destroyed.
If the tariffs on apple imports from the United States reduce to zero, the apple farmers of Himachal Pradesh, Kashmir and Uttarakhand, in which more than 1.5 million families are engaged, their livelihood will be impacted and this will be destructive. Considering this, I appeal to the farmers and labourers of this country that they should stand up against Prime Minister Narendra Modi's surrender in front of Donald Trump and America. And everyone should support the mass agitation being organised by farmers and labourers.
The free trade agreement, which has been announced by the Indian government, which is being discussed internationally, the terms and conditions of the agreement, which are being released, show that it is detrimental to the farmers, labourers and people of India.
Also, India's Agriculture Minister Shivraj Singh Chauhan maintaining that the deal does protect farmers.
Firstly, the interests of the farmers have been fully protected. No market has been opened, be it our main grains, fruits or dairy products. Everything is safe. This deal has been done keeping in mind the welfare of farmers and the country's interests.
There was another development that got a lot of interest in India. The US revised its own fact sheet of the trade deal with India. It made two changes. The US removed pulses from a list of products on which it said India will reduce or remove tariffs. Earlier, the word pulses was there. India's own trade agreement act and its agriculture chapter said pulses remain fully protected. The White House also revised the fact sheet to replace the word committed to say that India intends to buy more American products and purchase over 500 billion of energy information and communication technology, coal and other products from the US. Joining us now to discuss all of this and more is Siraj Hussain. He's the former Secretary of the Ministry of Agriculture, Cooperation and Farmers' Welfare and the Ministry of Food Processing. Siraj sir, thank you so much for joining us. Really appreciate it. I just want to get started by understanding from you, what do you see are the core economic or policy grievances motivating these farmer protests, beyond, of course, these immediate triggers, which appear to be, as I understand it, lower trade barriers on some farm goods, drawing criticism from these farmers and opposition parties. What do you make of all of this?
I think at this point of time, we do not know details of the agreement. And therefore, our assessment is only based on the information provided by the US side and also by the Indian side. And as you mentioned in your reporting, modifications have been going on from the US side. And therefore, we really do not know what India and US have agreed as far as the specific tariff lines are concerned. However, it seems that certain commodities will now be open for import from the US at lower duty or zero duty. Now that is causing concern in certain farmers organizations because it is feared that cheaper imports may affect the domestic prices of those crops due to which the farmers' incomes will be impacted. So as you mentioned, lentil is an example. Now lentil is understood differently in India and US. In India, lentil is understood as masoor, a pulse called masoor in India in Hindi. In the US, lentil, as far as I know, means entire spectrum of pulses. So unless we have clarity on these points, it is very difficult to make an assessment of how and to what extent the Indian domestic prices will be impacted by cheaper imports.
Okay, I'm glad you said that. That was a question I posed to a particular farm leader that I was speaking to. And I said, are you jumping the gun by saying that India has, well, conceded and made the deal at gunpoint, as has been quoted by some? because this deal hasn't been finalized, it is now interim, and negotiations are still ongoing. So should these farmers have waited before protesting?
Actually, it depends on how the government is communicating with the country. As you know, the terms of the interim deal were first announced by the US, and only later the government of India came out with its own press release. So a better communication, conversation with farmers' organizations, political parties, etc., I think is needed, will be helpful, because there are a lot of gray areas in which there is still clarity required. At the bottom line is that the US export, Indian export to US is $3.4 billion and import is $2.1 billion. So US would somehow like to export more of its commodities, especially soybean and maize. And I think the government has done well to protect the import of soybean and maize, because these are the two commodities which the US was exporting to China in very large quantity, and China, for a variety of reasons, has been taking it from Argentina, Brazil, etc. So US is looking for the market. I think Indian negotiators have done well to protect these two.
Okay. I want to get into these aspects, these gray areas, but I also want to understand one other aspect, which is that this isn't that only the farmers are believing this to be a net negative. It's also that we've seen the markets reacting in that way also. We've seen Indian corn and soybean prices fall on Wednesday. Soybean and corn prices fell 10% and 4% respectively since the interim framework was announced last week. What's your take on that? Is the market overreacting?
No, the market is not overreacting. What is happening is that DDGS is specifically mentioned. Now, DDGS is a product of refining the maize and rice. In India also, DDGS is being produced. Indian DDGS is not of very high quality. There are instances of aflatoxin in Indian DDGS. So, import of DDGS will be welcomed by the poultry industry, feed industry, and it will have an impact on maize prices. That is how the maize prices have reacted. So I do not think it is out of turn. There is a fear that import of DDGS will have an adverse impact on maize prices realized by the farmers. In any case, I think our government has been encouraging production of maize for making ethanol. I think that is a policy choice which needs to be modified and reconsidered.
Okay. How would you suggest it should be modified and reconsidered, and why are you suggesting that? Are you suggesting that because it's a net negative for farmers or some other reason?
Actually, I have written several papers on this. You see, India is deficient in proteins. So our policy choice should be geared towards promoting the cultivation of protein crops rather than maize for ethanol. What has happened is last Kharif, the area under corn, maize went up by about 10%. The area under pulses went up by just about 1%. I wrote a piece yesterday in Deccan Herald. Your viewers may like to have a look at that. So our policy should be encouraging larger area under pulses and maybe a smaller area under maize. There is, a need to reconsider this policy of making ethanol from maize and giving it a preferential price for ethanol as compared to ethanol obtained from sugarcane.
Okay, that's fascinating. Let's just get into these concerns. There are three concerns: soy oil, maize, processed dairy. And what is understood is, and you've kind of alluded to this, that India has allowed the imports of protein-rich distilleries, dried grains, DDGs that you were talking about, with solubles, a byproduct of ethanol made from corn and other grains in the US that could impact domestic oilseed producers and soybean farmers if US imports rise. One of the concerns that I've heard about is that India cannot, at this point in time, meet its own minimum support price that it has, and it's falling below that. And the other is that India's ethanol producers themselves are struggling with idle capacity and slowing demand after the country already achieved its 20% biofuel blending target. So in that context, what I'm trying to understand is that given the current read of the interim agreement, is it saying what the farmers are claiming, or are the farmers believing that it is going to be a certain way later?
I do not think the farmers' organizations or even the opposition parties or even the government, the public at large has details of the agreement. I think it is premature for any large-scale agitation to take place at this stage unless we know the details. Now, as far as soybean oil is concerned, you see, we have been importing soybean oil from Argentina in quite a substantial quantity, and that is also genetically modified. That is also obtained from genetically modified soybean. So import of soybean oil from US, if it comes at a lower duty, will make it more competitive. And therefore, it is quite possible that Indian importers will prefer US soybean oil rather than Argentinian soybean oil. So it would not have much impact on the domestic prices as such. DDGS, as I said, has an impact. However, if soybean oil from the US comes at a very low price as compared to the current price of $1,100 a ton or so, then soybean prices will get depressed. As it is, the farmers have been realizing about 20 to 25% lower prices for soybean than the minimum support price. So soybean is already facing a crisis in India. The productivity is also low. This concern about soybean is quite genuine. However, since we do not know full details, how much quantity, I understand that there will be a quantitative restriction. So what is the quantity India has committed? We do not know that.
Yeah, this is the thing. A lot of what is being written so far in terms of, the interim trade deal is under this quota. And one example is duty-free cotton. The permit that is being given is only for extra long stable cotton. So India currently imposes an 11% duty on cotton imports and allowing duty-free imports from the world's largest exporter of the fiber could put pressure on India's domestic prices. However, the impact is expected to be limited, is what Reuters has said, because the government has permitted only imports of extra long staple cotton, and that too under a quota. And this is not just the case for duty-free cotton. This is also, as I understand, for apples and dry fruits. So this quota is what we don't understand right now. Is that what you're saying?
Quota means that only a certain quantity will be allowed to be imported at lower duty. And a quantity above that will attract the normal duty, the MFN duty. Of course, the entire WTO regime is now in tatters. So this whole business of most favored nation treatment and the duty structure has gone for a toss. I do not know what future has in store for that. Now, as far as cotton is concerned, US cotton is accused of destroying the livelihood of cotton farmers in Africa. Therefore, there has been a very genuine fear in India about import of cheap cotton from the US. Long staple cotton we have been importing from various countries, including Egypt also in the past. And last year, the textile industry itself asked for cheaper import from the US, which was allowed till a certain date. I think that permission has expired now. So, some import of cotton may be necessary for making garments. But now there is a new dimension to this. Bangladesh has entered into an agreement with the US that it will not, Bangladeshi textiles garments will not face any duty in the US if they use 70% of cotton imported from the US. So, these things are all impacting each other.
Okay, we will be actually getting into the Bangladesh conversation, but final question, because we're out of time. We'll be getting into the Bangladesh conversation in just a bit, because we want to cover that. But for you, sir, we talked about how tea, coffee, spices, and fruits are set to gain from the trade deal. Anyone who, works in that space in India. But net, given what you're seeing right now, are Indian farmers likely to benefit or lose?
It is very difficult to say, but I think on the whole, the deal may be quite beneficial, but a lot depends on what will be the non-tariff barriers in the US. It is easier to say that our fruits can go and, nuts can go and so on, but there are so many non-tariff barriers in the US, phytosanitary restrictions, etc., due to which mangoes, for example, Indian mangoes have not been going to US because of phytosanitary restrictions. it needs nuclear treatment, so radioactive treatment. So a lot of import and export from US to India and India to US will depend on non-tariff barriers also.
Okay, sir. Thank you very much, sir. Non-tariff barriers is a big part of the conversation. That was Siraj Hussain, former secretary in the Ministry of Food Processing and Ministry of Agriculture, Cooperation and Farmers' Welfare. Appreciate you coming on. On the other side of this break, the U.S. jobs report coming in better than expected, but markets breathe a sigh of relief on the state of the labor market. We'll be back with more details in just 2. All right, welcome back. Let's just take a quick look at U.S. futures. What do we know right now? Well, slightly positive implied open for all three. This is as much as we've got from the much awaited jobs report overnight, having a perhaps impact on just futures and the market. The U.S. non-farm payrolls came in stronger than expected to kick off 2026, providing some relief to concerns about the state of the labor market, but downward revisions from the previous year are still adding to some of those worries. The cumulative number of new jobs in the U.S. economy in the second half of 2025 now standing at an overall net loss. And CNBC's Steve Leisman has more details in this report.
A big beat on the January U.S. payroll report, holding out hope that the job market could be turning around, but raising questions about how much faith markets should put into this one strong number. At 130,000, it was more than double the expectations. The unemployment rate fell to 4.3%. It had been expected to remain the same. Participation rate, it also rose. Labor slack declined, and there was a stronger private sector compared to the full report. But among the questions raised on the jobs report, it was triple the prior 2 months, and there were big seasonal adjustments helping out retail, for example, and possibly some weather effects with actually above normal temperatures in the first half of January helping construction. That was before things turned bitterly cold. There was also concentrated job growth in healthcare, but some gains in manufacturing. Meanwhile, there were huge downward revisions as expected. In 2024, the U.S. created 1.5 million jobs. Before the revisions, we thought it was around 500,000. Now it's been revised down to just 181,000 jobs created in 2025. On a per-month basis, that brings it down from 49,000 to just 15,000 a month in 2025. Futures prices continue to price in 2 rate cuts, one in June, another one by the Fed in October or December. It had been flirting with higher probabilities on possibly earlier cuts, but that's been washed out by the stronger jobs number. At the very least, this number confirms the Fed take that the job market has stabilized. But confirmation that the U.S. is off to a new spurt of strong payroll gains will have to await a less noisy month for confirmation. Steve Leisman, CNBC Business News.
All right, despite that stronger than expected jobs data, some of the big money on Wall Street are betting the Fed is more likely to cut rates. Greenlight Capital's David Einhorn is one of them.
I think it's going to be a lot more. You know, President Trump believes that the U.S. should have the lowest interest rate in the world because he thinks we're the best credit. And he's been mad at the Fed chair since he took office, screaming at him to lower rates. So he's picked his new guy. And his new guy is going to come in and he's going to lower the rates.
He has to convince the rest of the committee to
I know that's the story on Wall Street, right? Which is, oh, there's 12 people, they have to be convinced. The thing is, has the Fed chair ever been a dissenting vote in his own decision? Like, I don't think that's ever happened before. And I think that Kevin Warsh, who I've met and I think is very articulate, he's going to come up with arguments that are going to persuade people. He's going to say, if the economy is running hot, like say the jobs report this morning, that's not a reason not to cut.
In 2026, the overarching story is that if jobs are shrinking and AI is wreaking havoc across sectors. Remember, software used to eat the world, right? It's a $450 billion sector. Now that's getting eaten by AI. If software shrinks, that's deflation. So I think the inflation picture and AI is showing it's actually disinflationary. And we get a CPI report in January from this Friday, but core CPI year over year might drop to 2.52. That's the average from 2017 to 2019. We're back to pre-COVID inflation. So I think we have a dovish Fed coming, and then Fed funds rates were like 1.5, 2.0 back then. So I think there's a lot of room to cut rates. So I think it's a disinflationary environment.
The U.S. House has delivered a rare rebuke to President Trump, narrowly voting to roll back his tariffs on Canada. 6 Republicans joined almost all Democrats to pass a resolution ending Trump's use of a national emergency to impose punitive trade measures. While the measure could also pass the Senate, it's unlikely to become law because President Trump is expected to veto it. Supporters say the tariffs are raising costs for American families and are unjustified. Noting Canada is not a security threat, Trump hit back, warning dissenting Republicans could face consequences at the ballot box and insisting Canada has taken advantage of the U.S. on trade. More news and updates coming up on the other side of this break. Welcome back. You're watching Inside India. Some of the stories that we're keeping tabs on, let's bring them to you. The first, Indians have been helping to fill Russia's labor shortfall as nearly 72,000 permits were approved for Indian nationals in 2025. A staggering increase from just 5,000 permits okayed in 21 and making up a third of Russia's annual migrant visa quota. This surge reflects strong defense and economic ties between the two countries, despite mounting U.S. pressure on India to halt its purchases of Russian oil. Moscow has acknowledged a need for at least 800,000 workers in manufacturing and another 1.5 million in the service and construction sectors. Also, India's Petroleum Minister Hardeep Singh Puri has acknowledged that he met the late convicted sex offender Jeffrey Epstein several times while working in the US, but maintains he had no involvement in any wrongdoing. Puri said he encountered Epstein 3 or 4 times through a New York think tank where he served, and that their emails mainly related to discussions about inviting LinkedIn founder Reid Hoffman to India. Puri was responding to questions in Parliament from opposition leader Rahul Gandhi, who pressed the government to clarify Puri's links to Epstein, citing emails released by the US Justice Department. Also, India has ruled out any relaxation of its ban on e-cigarettes, dealing a blow to a sustained lobbying campaign by global tobacco giant Philip Morris International. The company had hoped India would open its market to its flagship heated tobacco device, IQOS, which is allegedly less harmful than traditional cigarettes. Of course, we're counting down to the market open, which is in about, 14 minutes. This is how we're shaping up. It's looking muted. It's looking like Nifty will continue to flirt with 26,000. It is something that's been happening now for 2 days. It hasn't gone past 26, and that's the key that we're watching out for. The US dollar India rupee is becoming even more interesting. The rupee strengthening 0.3%, quite a lot against the dollar. It did strengthen even more during intraday sessions earlier this week to about 90.12, but at this point in time it is at 90.46, and we're going to keep watching this as earnings season continues, and of course more details emerge between the US and India, and there's consumer inflation data that is expected later today. Also, voting in Bangladesh has begun in an election that is critical for the biggest sector there, textiles. Bangladesh and the US, remember, signed a deal just earlier this week, 3 days before the elections, that were basically under the purview of an interim government. And that particular deal saw their tariffs fall to 19% compared to India's 18%. But that's not the catch. There's a different catch that gives Bangladesh's textiles industry a bit of an edge, and we'll get into that. But let's just break down what's happening with Bangladesh's elections. It's headed to elections after a tumultuous time. 127 million eligible voters in the election. This is the return of democracy after an interim government, which was led by Nobel Peace Laureate Muhammad Yunus. Also, it's interesting because the entire political landscape has evolved and changed, and that's why it's difficult to predict who's actually going to win. There are now 2 basic coalitions. The 10-party coalition led by Bangladesh Nationalist Party versus Jamaat-e-Islam's 11-party coalition. The lead parties are obviously going to be competing for the larger share of the seats, and opinion polls are suggesting that BNP, that's the Bangladesh Nationalist Party, holds an edge versus Jamaat Alliance. The BNP is seen as centre-right, and Jamaat Alliance is seen as conservative-right. The main issue, of course, is corruption. It has been voted by voters as their top concern, according to polls. Rising prices is the second big concern. Inflation, remember, edged up to 8.58% in January. That's official data, by the way. And voters have ranked economic development as their third biggest concern. In Bangladesh, a country that's developing, it has been developing relatively fast but slowed down in the recent past. Jobs remains a very key concern because 40% of Bangladesh's population is under 30. There's also an unusual referendum in Bangladesh's election, which doesn't usually happen. Voters will be deciding on 4 major reforms: creation of new constitutional bodies, a bicameral parliament, and term limits for prime ministers, enhanced presidential powers, all in the backdrop of geopolitics, where China is continuing to have greater influence in the region, while India's relationships with Bangladesh have been, not that great ever since that particular situation where the Sheikh Hasina, the Prime Minister of Bangladesh, the then Prime Minister of Bangladesh in 2024, had to flee Bangladesh and has been then in India since. All right, let's bring in our guest and get a sense of what this means for India. Ashwin Chandran is the chairman of the Confederation of Indian Textile Industry. Ashwin, I really appreciate you coming on. You know, Bangladesh accounts for 80% of its exports for garments and textiles, a major supplier for global brands, and I want to say this out, like H&M, Primark, Walmart, and Target. This is the country's biggest industry, and it has suffered for 6 straight months because of falling exports, because of US tariffs, and generally the political unrest, the political instability. So that matters for global supply chains. I want to understand, if you just zoom out for a second, what are the implications for everyone, the global textiles industry, the Indian textiles industry, from the Bangladesh elections?
Good morning. Thank you for having me. As you rightly said, Bangladesh is one of the largest exporters of textiles and apparels in the world, especially apparel and ready-made garments. India is a strong competitor. We exported about $37 billion worth of textile and apparel last year, but Bangladesh is bigger than us, and they have a larger market share compared to India in both the US and the EU markets, the 2 biggest consumer markets in the world. While there has been turmoil in terms of geopolitically in Bangladesh, and they've had issues with rising costs, higher gas prices, they still remain very, very strong as a garment supplier. They account for over 80% of their country's foreign exchange earnings. And so the government has to support the ready-made garment industry, which it has been doing. But European brand retailers especially have been looking at alternatives to Bangladesh. They feel that they are over-dependent, over-reliant on Bangladesh at the moment. And with India signing the free trade agreement with the EU, which hopefully will come into force in the next 6 to 9 months, it will give us a more level playing field as far as supplying to Europe is concerned. And we will be able to compete with Bangladesh on a more level keel.
Okay, what is the disadvantage in terms, if you can quantify it, what is the disadvantage for India right now?
Yes, presently it's about 10 to 12%, depending on the kind of product, whether it's a home textile product or whether it's a garment. The disadvantage that Indian suppliers face today vis-a-vis Bangladesh is 10 to 12%.
Okay, and how long have they faced this?
Ever since, Bangladesh until 2029 has a preferred nation status in its dealings with the EU. Therefore, we've had this for the past 12, 13 years, since about 2012.
All right. In that context, then, what could be the impact of what's coming now, which is the key point in the Bangladesh-US trade deal, that there could be 0 tariffs on its textiles to the US if it purchases cotton from the US effectively. And that's an interesting point. Of course, there's a quota there. Remember, Bangladesh buys and imports mainly from Brazil, India, Africa, and the US, but this would mean that its share of the US would increase a lot more. So that disadvantage to India would go from 10 to 12% to what then?
No, 10 to 12% as far as the EU. As far as the US is concerned, at the moment, we have a tariff of 18% and Bangladesh has a tariff of 19%. The point that you talk about, we still haven't seen the fine print. There are 2 views on it. One says that it's going to be a country-level quota, whereby if Bangladesh purchases X thousand tons of American cotton, then the US would allow proportionate imports of, say, Y million garments. There's another view which says each product has to be made from American cotton, so the person who's manufacturing the garment has to source US cotton or US cotton-made yarn to manufacture their products. So we're not very clear on this at the moment. But one thing which is a relief to Indian exporters is that yesterday, during an interaction with the Textile Export Promotion Councils, our Honorable Commerce Minister, Mr. Piyush Goyal, clarified that whatever conditions are going to be put in place for Bangladesh, the same conditions will be offered to India when we sign our bilateral trade agreement next month. So that is some reassurance to our Indian garment and home textile manufacturers and exporters. We have been given an assurance that we'll be on a level footing with Bangladesh in that regard.
But we've never really had a level footing because Bangladesh has always had a competitive edge. So even if we have that level, playing field, how do we fix that competitive, edge problem? I want to, as you dive into that, let's also remind our viewers that, and I want to bring up some of these, if we can, the shares of major companies in the Indian textile sector, Gokuldas, Pearl Global, Kitex Garments, Arvind Fashions, and the likes, tumbled up to 6%, extending losses for a second session after the Bangladesh-US deal. So I just want to get your perspective on both these points now.
Yes, it's been a volatile time, since the trade deal was announced on February 2nd, or the tariff relief was announced on February 2nd. All apparel makers, I think, had their share prices move up significantly. But like you rightly said, over the last couple of days, post this Bangladesh news, share prices tumbled again. But I think this reassurance from our Commerce Minister, which should be hitting the media today, I think that should give reassurance to both the markets as well as our garment and home textile exporters.
I'm sorry, can I just ask you, were you part of that meeting with the Commerce Minister?
I wasn't personally, but our association city was invited. I wasn't able to make it to Delhi yesterday, but we had our deputy chairman there. We had the Apparel Export Promotion Council chairman there. So I've had first-hand news from them that this assurance was given by our Commerce Minister.
I understand. So let me ask you this. Is the market reacting correctly, or is it overreacting? What is it? Because, this trade deal that Bangladesh struck really does further enhance its advantage on textiles against comparatively to India.
It does, no doubt. But like I said, the fine print is yet to come out. But the developments over the last month, if you look at India signing agreements with the UK and then subsequently with the EU and now the developments with the US, I think all these are very, very positive for Indian textile and apparel. And I definitely see a brighter future in the next 2 to 3 years. There's already been, over the post-COVID, there were signs that India was getting a share of Chinese global exports. That's translated into US market share numbers. And now with the EU also potentially opening up next year, I think overall I'm quite enthusiastic about the next 2 to 3 years for the Indian textile and apparel industry.
Okay, I'm glad you mentioned that because I wanted to come in and talk about the budget, on Feb 1st, one day before Bangladesh-US happened. And of course, even, 2 days before, because we also had India-US happen one day after the budget. So the budget introduced a push for the sector, mega textile parks, fiber to fashion value chain support, upgraded skilling, sustainability initiatives, export facilitation measures, cluster modernization, which was really needed to boost competitiveness. But do you see this getting implemented?
Yes, it's only the pace, which is a question. Definitely in terms of the PM Mitra parks, in terms of the PLI scheme, in terms of cluster development, all these have already been, initiatives have been taken in these regards. So it overall bodes well. The only thing which the industry was hoping for and which we've been fervently asking for is relief on the import duty on cotton. The country, India, presently imposes 11% import duty on cotton. That is something which is a disadvantage for the industry. And we have been seeking the permanent removal of this duty. So if that happens, I think that will be an added boost to our textile and apparel industry.
But do you see it happening as India targets its textile export of USD, $100 billion by 2030, and we're at about, correct me if I'm wrong, 45 billion or so?
Slightly lower, but yes, it requires 16% compounded growth rate to hit that 100 billion target. So we need, like I said, a level playing field, which these FTAs will provide. We also need a level playing field in terms of raw material. We've seen some relief with regard to man-made fibers. We had quality control orders in place for man-made fibers, QCOs as they were called, which were then removed during the latter part of last year. So that was a very positive development. We are hoping for the same relief with cotton as well. We had a period between August and December of last year where cotton imports were exempt from duty. We still can import cotton under an advance authorization scheme, which is a zero duty scheme, but then it penalizes the importer by denying them certain export incentives like duty drawback. So we've been asking for just a clean slate, zero duty on import of cotton, which will make things easier for businesses who wish to import.
Well, the Indian government has been on a slew of reforms, so let's hope that what you're asking for, well, the government considers it as much as it can. I really appreciate that. Ashwin Chandran from the Confederation of Indian Textile Industry. Coming up, Indian markets have joined the trading day. We'll look at some early movers in Mumbai after a very short break. Well, Indian markets have come online. It's been about 2 minutes. The Nifty 50 was expected to have a muted opening, and it's fallen 0.3% at this point in time. It has been in this range of about 25,800, 25,950, but it has not gone and hit that mark of 26,000, which is seen as a support price, another level going back into what was happening a couple of weeks ago, and seen as relatively positive. What's interesting at this point in time is what's happening with the Indian rupee. It's at 90.51, strengthening overall over the last couple of hours. Remember, it touched almost 90.7. It was also at 90.12, and there are reports that are saying that the Indian Central Bank likely sold dollars before the local spot market open. That is today, on Thursday. That's what 6 traders told Reuters. Let's also look at some of the movers. LG Electronics. India imported a sharp slump in quarterly profit, down nearly 62% as cooler weather and weaker demand hit sales of air conditioners and home appliances. Profit for the December quarter fell to about 900 million rupees, while overall revenue slipped 6%. Now, LG said it avoided cutting prices to protect margins, even as dealers struggled with high inventories after the Diwali season, and the market there very clearly reacting 5% down. Battery maker Amara Raja posted a sharp drop in Q3 profit, with earnings falling more than 50% as higher raw material costs and a one-off charge linked to India's new labour codes weighed on the bottom line. The shares at this point in time down almost 4%. We're also watching eyewear retailer Lenskart posting a strong quarter, with profits surging 70 times year-on-year, driven by robust demand for prescription eyeglasses. The company continues to expand across Southeast Asia and the Middle East. That's why Lenskart shares up a massive almost 10%. And automaker Mahindra & Mahindra reported a nearly 33% rise in quarterly profits, supported by strong SUV demand following recent consumption tax cuts. But the shares down 1.3%. We're also watching, and perhaps the whole country is watching, Fractal Analytics' 314 million IPO, which was fully subscribed on its final day of bidding. The company is set to list on Monday, February 16th, and it would mark the first listing of a pure-play Indian AI company. Investors bid for 27.2 million shares against 18.6 million on offer, with institutional buyers leading the demand. Fractal priced the issue between 857 and 900 rupees per share, valuing the firm at up to 1.6 billion. The company, which accounts Microsoft and Alphabet among its clients, cut its issue size earlier, reportedly to attract investors. And onto one company that shook markets and IT service providers in India as well. The launch of Anthropic's AI model Claude has somewhat fueled a rout in AI names, leading to as much as 300 billion in losses on just the Wall Street so far. Now, Anthropic's teaming up with Man Group, an investment management outfit, to put AI at the center of investing. CNBC's Arjun Kharpal caught up with Anthropic's chief commercial officer, Paul Smith, and here's what he had to say about the rising competition in the software space.
What we started to see towards the end of last year and over the Christmas period were a number of people who were using Claude Code for non-coding tasks, for effectively performing some like personal workflows, for stringing together a whole series of tasks, for doing deep research, analysis, content creation, and so forth. And one of the things that kept coming up is, I love using Claude Code for this kind of stuff, but I wish it had something other than a command line interface as the way that I engage with it. So CoWork, you could almost think of as like Claude Code for non-coders. So we released it at the start of the year in response to that user demand. But first and foremost, we're a platform company. So we make all of this capability available for other organizations to build on top of as well. So if you look at what we did at the beginning of last week, and we announced these legal plugins inside of CoWork. Now, we use some of those plugins internally for how we manage legal work. We see some of our clients using them as well. But we also made them available on our API at the same time as well. So if you're a specialized AI company or specialized legal firm building things on top, you're able to take those same plugins, kind of like a reference architecture, and build on top of it. So everything we do is really ultimately available to amplify what other people are able to do and build on top of as well.
But when you speak to organizations like Man Group, for example, and some of the other enterprises you work with, how much of the conversation is, hey, we love your products, we think actually we'd like to use that so we can phase out software we're using in X area, whether that's customer service, whether that's HR, whether that's legal?
It depends on which organization you speak to. And what we typically find is there are some organizations which are doubling down on certain software categories and on certain products, and there are other organizations where they're going, you know what, that is more peripheral to what our core business is, so maybe we will use some other tools to do something different. So it really does depend on what you're doing as a particular company and where your particular focus is.
So this sort of broader meltdown we've seen in software stocks, for example, as a result of kind of the successes of CoWork, do you think that's overblown to some extent?
I mean, I think there was a lot of hyperbole in the market last week, and as a lot of folks pointed out, those applications perform some very important tasks in an enterprise. They have some very specific data models. They have some very specific workflows that organizations are going to get a lot of value from a very long time. What I absolutely see is people innovating way more quickly on top of them than ever before and extending them in like personalized, customized ways than ever before. So in my enterprise, you know, I can say, hey, I want to see the data like this and I want to see this information here. Claude Code, can you do all this from me? And it'll be taking data from CRM, from customer service, from various other sources. So I see it kind of coming together like that.
And ChatGPT maker OpenAI is eyeing South Korea now and is planning to build data centers in the country next month. Lisa Kim, our East Asia reporter, joins us with more details. Lisa?
Hey, Amitabh, that's right. OpenAI is teaming up with SK Telecom and Samsung SDS, two South Korean companies, to start building data centers in South Korea starting in March, that is. Samsung SDS is South Korea's largest cloud service provider, and SK Telecom is the telecommunications arm of SK Group, which is one of the biggest conglomerates in South Korea. Now, OpenAI and SK Telecom said in separate statements to CNBC that they are, in fact, in talks about this new project, but none of them agreed to disclose the exact timing. But who did share the time frame was South Korea's Science Minister Bae Kyung-hoon. He told the legislator yesterday that OpenAI, Samsung SDS, and SK Telecom will likely start building out the data centers in March. The recent development comes after Sam Altman's visit to South Korea in October, during which he signed a lot of documents and met a lot of executives in South Korea, including on data center construction. And also, you might be wondering, why South Korea? According to OpenAI, South Korea has the second highest number of paid ChatGPT subscribers just after the US. And this is notable because South Korea's population is 1/7 that of the US. Also, for the part of South Korean government, it's offering tax credits of up to 25% for AI facilities for a limited period of time to attract these cutting-edge businesses. And I looked into how South Koreans use these AI chatbots, and Korea Press Foundation report from last year says that they use these chatbots primarily as their search engine for writing, and also to edit, generate photos, and to translate foreign languages and to study languages. Amitabh?
Thanks so much for that, Lisa. I did ask ChatGPT whether India was also in this list, and it said the second largest market. It is. India is the second largest market by total visits and rapidly growing user base. That's all the time we have today on Inside India. Keep watching CNBC. Access Middle East is up next.